Hello, everyone. Today I want to talk a little bit about reading options quotes and some things you need to pay attention to keep yourself from getting a unwelcome surprise of getting a very different price than you thought you were going to. So here I have, these are just calls for Apple, and I wanted to pick Apple because it's very, very liquid. Here we have what we call the expiration date. When you buy an option, you're buying a contract. You're entering a contract with whoever is on the other side. In other words, you buy a call, someone sold you that call. The call gives you the right to buy the stock at a particular price. That's called the strike price over here. So if you buy a call and just say you have a strike price of 160, you can buy Apple at 160 regardless of where it's trading in the market. If it's trading at 180 and you have the ability to buy it at 160, your contract's going to be worth a lot of money. The person on the other side that you bought the contract from, in this case a call option, calls give you the right to buy. The person that sells it to you is guaranteeing that they're going to sell it to you at 160 regardless of where it is. So they think it's going down, you think it's going up. The same works for puts. Puts give you the right to sell at a certain price. A put is the opposite of the call. A call gives you the right to buy it at a specific price, which we call the expiration price, or I'm sorry, which we call the strike price, up to the expiration date. A put, if you buy a put, it gives you the right to sell a stock or a crypto, I'm just going to say stock. It gives you the right to sell a stock at a certain price, which is a strike price, up to the expiration date. So we have our expiration date over here. We have our strike prices over here. This column here is what we call open interest. This tells you how many contracts there are in existence. Okay, if you go out and you buy a contract and someone else sells it to you, well, then that would add to this open interest. This would go to 71. Okay, this is the volume, how much is traded today, and we can see these are very liquid. This is the bid, and this is the offer. All stocks or options have what we call a bid and an offer. The bid is the highest price anyone is currently willing to pay you, or to pay for the option. The offer is the lowest price anyone is currently willing to sell at. So we can see here, if you were to sell this option, you would probably get 1130. That's the price you would receive. And if you were to buy it, you'd have to pay 1150. Now over here, we have what we call the last trade. Notice how the last trade is outside of this range. The difference between the bid and the offer, we call that the spread. So this trade is outside of the spread. Now, people can get in trouble with this because they are trading and they see, oh, this just traded at 1161. That sounds like a good price. I'm going to sell my option, right? I'd sell this at 1161, but you end up getting 1130 because we don't know when this last trade was. It could have been last week. It could have been a couple hours ago. It has really no relevance to what the current market is. So we want to pay attention. Remember, the bid is the highest anyone is willing to sell or pay you for your contracts, and the offer is the lowest anyone is willing to sell the contract. If you were to come along and you were to say, all right, you know what, I don't want to sell at 1130. I'm going to put my order out as a limit order to sell at 1145. This quote here would switch from 1130 to 1145 because now you are the one with the lowest, who's willing to sell at the lowest price. So be careful. Sometimes the last trade has no relevance to the current market. When you have a liquid stock like this, this is Apple. We got all this contracts trading. Look how narrow these spreads are. They're only 1 cent. And that's what you get on a liquid stock. Now, I'm going to look at a stock that is not so liquid. This is U.S. Steel. Now look at this. See how the open interest is much lower? The volume is much lower. We have, look at this quote, right? 259. The current quote is 215 to 226. So this could be a situation where you want to sell. It's like, oh, I'll sell mine at 259, and then you get 215. So I'm not saying you shouldn't trade illiquid securities or illiquid options, but you just need to be aware of these things, right? You need to be aware of what's the bid, what's the offer, what's the volume, what's the open interest. A stock like Apple, it trades so much that the bid and the offer are always going to be really tight, meaning the spread is going to be really thin. There's going to be a lot of volume. A stock like this, it just doesn't trade as much. An option like this, it just doesn't trade as much. So here's a situation where, it traded at 66. I'd like to buy it at that. That's a good price. And you end up paying 69. Here we got an old quote, or an old last trade is at 95 cents. The current quote is 97 to 102. So you might say to yourself, oh, I would buy that at 95, and you end up paying 102. So remember, we want to pay attention to what's the bid. That's the highest price anyone's willing to pay. What's the offer? That's the lowest anyone's willing to sell at. What's the volume? Because if the volume is really low, when you place your order, you might actually affect the market. Like for instance here, we have only 16 contracts have traded today. If you were to come along and sell 10 contracts at the market, because this is so illiquid, you might push this price down. In other words, you might get 133 for your first contract, you might get 130 for your second contract, you might get 125 for your third contract. So a way to get around that is not to sell at the market, but to place a limit order. A market order just is you go out and you sell or you buy at whatever the best price is in the market. So you're guaranteed an execution, but you're not guaranteed the price. A limit order, you specify, oh, I'm going to sell this at 135. So you're guaranteeing a price, but you're not guaranteeing an execution. In other words, if no one comes along to buy your contract from you, or no one comes along who's willing to pay 135, well, your order is not going to be executed. So market orders are usually okay on really liquid things because the spread's going to be pretty tight. But if it's illiquid, you may want to consider using a limit order so you don't end up adversely affecting the price and getting less of a profit. All right, so that's it, everybody. Just to refresh or to sum it up, we got our last trade, how far down this is from the prior trade, the current bid, which is the highest anyone's willing to pay, the current offer, which is the lowest anyone's willing to sell at, the amount of volume that's traded, and the amount of open interest. And over here we have the strike price. Okay, thanks a lot, everybody. I will talk to you soon.